RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today. Hey, stay tuned. The second segment of today's program has me interviewing Mr. Brien Lundin. Brien is the founder and host of the largest investment conference in the world. It's the New Orleans Investment Conference. He's also the publisher of Gold Newsletter. Brien and I are going to chat a bit about his take for future metals prices. We're going to talk about what happened recently in the gold and silver markets and where he sees the U.S. economy headed. So, given that the Dow last week, many of you obviously are aware of this, given the Dow last week hit a new high of 50,000, does it mean that we're in a bull market and the bull market will continue? Well, maybe, but if it does, I'm here to tell you that it's probably not for the right reason. Much of the appreciation that we have seen in stocks can be attributed to a weaker U.S. dollar. As I've pointed out many times previously, stocks are higher when priced in U.S. dollars that have been notably devalued. But stock prices are not higher when you price them in gold, which has been real money for most of history. Give you a very quick example. Back in January of 2000, the S&P 500 was at about 2,800. Gold was about $500 an ounce, so it took about 5 ounces of gold to buy the S&P 500. Today, the S&P 500 is just shy of 7,000. Gold is about $5,000 an ounce. So now it takes about 1.4 ounces of gold to buy the Dow when it used to take 5 ounces. So stocks have gone up in nominal terms when priced in U.S. dollars that have been devalued. However, in real terms, in gold, the price of stocks has declined. Now, the metrics of stock valuations simply don't support higher stock prices. If you've been a long-time listener to RLA Radio, if you've been a viewer of the program for a long time, you'll probably recognize Dr. Mark Faber as a past guest here on the program. Faber is the publisher of something called the Gloom, Boom, and Doom Report. And he noted last week that U.S. stocks have never, underline never, they've never been this expensive. Faber notes that the price-to-sales ratio of the S&P 500 is now 3.47 times. What does that mean? It means a stock investor pays $3.47 for every dollar in revenue generated by S&P 500 companies. This is an all-time high. Now, when a stock investor pays $3.47, keep in mind that's for revenue, that's for sales, that's for gross cash flow. That's not for earnings. Now, here's a real shock. That ratio, that 3.47x ratio, is now 53% higher than it was at the time of the tech stock bubble in 2000. At that time, the ratio stood at 2.27x. For perspective, the ratio averaged about 1 during the 1990s, and at the stock market bottom in 2008, it was about 0.8. So valuations are now about 450% of what they were at the stock market bottom in 2008. So looking at these valuations, it points toward probably lower stock prices. It points to a correction. However, should the Fed be able to once again create currency, devalue the dollar enough to pump up stocks, that's the one circumstance under which I think we can see stocks move higher. However, that will also mean inflation is once again an issue. Inflation, of course, is a drag on the economy. Commercial mortgages are also now a drag on the economy. Wolf Richter last week reported that the default rate on commercial mortgage-backed securities spiked by more than 1% in January. The delinquency rate on office mortgage is now, get this, 12.3%. That 12.3% delinquency rate is 1.6% higher than the worst number seen during the financial crisis. The spike in the default rate in January was largely triggered by two Manhattan office towers. I'll share with you the story of one. The tower is the One Worldwide Plaza. It is a 49-story, 2 million plus square foot tower on 8th Avenue in Manhattan, and it has $1.2 billion in debt. Now, $940 million of this debt is senior commercial mortgage-backed securities. Another $260 million is mezzanine financing. Now, if you're not familiar with mezzanine financing, let me use an analogy relating to your home mortgage. Your primary mortgage, your first mortgage, is the equivalent of a senior commercial mortgage-backed loan. Mezzanine financing is like a second mortgage. So just like your second mortgage is junior to your first mortgage and senior to your equity, mezzanine financing is junior to the commercial-backed mortgage, the commercial mortgage, and it's senior to equity in the project. So essentially, this is like a second mortgage on a home. Senior lenders get paid first, mezzanine lenders get paid second, owners get paid last. Now, One World Plaza did not have the cash flow to pay the January 2026 tax bill, and it didn't have enough money to make its monthly payment on its mortgage in December. The property has a vacancy rate of 37% in 2025. That's up from 10%, so it's up 27% from 2024 after one tenant left and another tenant downsized. Here's the big kicker, and the thing you should pay attention to. In 2017, there was an appraisal done on this building, One World Plaza. When the appraisal was done, the building was appraised at $1.7 billion. It's that $1.7 billion appraisal that both the primary lender and the mezzanine lender used to decide to loan One World Plaza's owners money. The collateral is now reappraised at $390 million. If you're doing the math, it went from a $1.7 billion valuation or appraisal to a $390 million valuation or appraisal. That's a 77% haircut. I've talked about this previously here on the program. I expect that commercial real estate will likely continue to be a drag on the economy. We're also seeing that as far as residential real estate is concerned. I'll be back after these words with my special guest, Mr. Brien Lundin. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Brien Lundin. Brien is the host of the largest investment conference in the world. It happens in New Orleans every fall. It's called the New Orleans Investment Conference. This year it'll be held October 28 to October 31. He is also the publisher of the oldest newsletter, the oldest investing newsletter in the country, I should say, Gold Newsletter. The website is goldnewsletter.com, and the advice that Gold Newsletter has given over the past 5 or 6 years has made a lot of subscribers a lot of money. So it's a pleasure to talk with Mr. Brien Lundin today. Brien, welcome back to the program.
Great to be with you as usual, Dennis.
So,
Good
Brien,
times for metals investors right now.
Yeah, crazy stuff. So let's start with the elephant in the room. We had a big decline in silver and gold as we're recording this last week, as people are watching this a couple weeks ago. I guess I looked at that as a technical correction. The maybe rally got a little bit ahead of itself. What's your take?
Yeah, a little bit of both, a little bit of everything. I'm not a big, conspiracy theorist, but I did find it difficult to believe that the nomination or choice of Kevin Warsh was a big surprise to the market. If you look at the betting sites, he was first or in second or close second all the way along as a potential choice. So that was not a big excuse. I think it was just enough of a trigger or excuse to send people trying to hit the sell stops on the way down, and in fact rescue a lot of players who had been short the market, and obviously with that furious run in both gold and silver and really all the metals, were hurting pretty badly. So this was an attempt, I think, to rescue those shorts. I think the fact that margins had been raised on a percentage basis on the way up, and right before that were raised again fairly severely before the sell-off. And then on the way down, they neglected to institute circuit breakers. And so actually the exchange itself was trying to get lower prices, which of course they did. I've been encouraged by the rebound since then, though. And this is not a, it's not a Western investor or Western trader story. It is a global story, a lot of it from Asia, and a lot of macroeconomic fundamental trends that, that are reaching important points. A lot of chickens are coming home to roost right now, and I don't think that this metals market can be derailed. I think we're going to have a lot more volatility going forward, but I don't think can be derailed.
So, Brian, interesting you say that because I've read that same opinion from many people that the margin requirements were raised, and I
Yeah.
think the same thing happened previously when the silver market corrected. So, let me ask you just from a moving ahead standpoint, do you think this is just going to be a bump in the road, to use that analogy? Do you think metals prices consolidate here? Do they move higher? What's your forecast moving ahead for both gold and silver?
Yeah, I do think that there was a technical correction in some degree, in that it had gotten overheated. The market was racing ahead so quickly, it was almost bound to trip up on itself at some point. And again, that was just the pin that hit that little bubble. But the fundamentals are still firmly in place. The biggest fundamental, as you know, I've been talking about for years, is the U.S. federal debt issue. There's no way you can grow your way out of that. There's no way you can raise taxes enough. There's no way, obviously, you can cut spending enough to make any difference in that. So the size of that debt and the cost of servicing that debt at anything approaching even normal interest rates means that we have to have low interest rates going forward. They're really constrained by the debt service costs at this point. And low interest rates are bullish for things. They're bullish for the monetary metals, gold and silver, commodities across the board that have their own supply demand stories, real estate, et cetera, et cetera. But more of a tangible asset commodity market going forward, I think, than the financial markets that we've had over the last couple of decades.
So, Brian, when you look at U.S. government debt and you look at the treasuries that are being sold, I think it's pretty remarkable that I think it's 80% of U.S. debt being sold now is for 2 years or less. At what point does the U.S. debt financing and refinancing problem become a tipping point for not only the Fed monetizing debt, but at the same time, that's got to be very bullish for metals? What's your take on that?
Well, it depends on how you define the tipping point. I think when the servicing cost of the federal debt reached 1.2 trillion, essentially as it is now, that's kind of a tipping point. We're spending more in servicing the federal debt than national defense. So it is a classic debt trap. If any private enterprise in this situation would be bankrupt long ago, any nation, other nation than the U.S., then the issuer of the global reserve currency would be punished by bondholders by now, and had their debt dramatically downgraded, instead of keeping treasuries as the bedrock of global reserves. So the tipping point has been reached, and I just said that the U.S. treasuries are the bedrock of global reserves. Well, it's actually been supplanted recently by gold, which now has a greater percentage of international reserves, sovereign reserves, and they're buying gold. Central banks are at the expense of the dollar. They're switching dollars into gold. And that's one of the reasons why this is a unique bull market in the metals, because we've never really seen that before. Every previous bull market, the central banks were selling. Now they're actually buying, and that makes a world of difference.
So, Brian, if you were to estimate where we are in this gold bull market, are we 20% of the way through it, 40% of the way through it? Is this the end game? How do you see this bull market in gold? What are you telling your subscribers?
Yeah, Dennis, I'm very frank with my subscribers that nobody really knows. Nobody's smart enough to plot out the exact path ahead, and the timing is always the tough part. Things either take longer or come much more quickly than you ever expect. But I think what we can only do is really recognize the trend. I think we're still fairly early in the process, but we are in the end game of this process. We've had 45 plus years of ever easier money since Volcker started lowering rates again in the early 80s. And over that process, that has conditioned the markets and investors that money will always get cheaper. And therefore, they were able to build ever greater debts. I mean, it pays off to do that because the currency gets depreciated. So we are, I think, in the end game, whether we need, one more cycle or two more cycles or three more to get to some kind of a reset, I don't know. But I do know that each one of these crises that get solved or alleviated by massive injections of liquidity by the central bank. After each one of these cycles, the central banks have to do more than they did before to get the same effect. And every time the currencies lose more and more credibility. So I think the only thing we can do as investors is recognize that trend and understand that as that trend progresses, you're going to want to own the monetary metals as insurance against that depreciation, currency depreciation, and try and find ways to leverage that move in other ancillary investments.
So before we explore this reset and the other ways to leverage metals in your portfolio, I'd like your opinion on the new BRICS unit, this unit that the BRICS countries are rolling out or have rolled out, 40% backed by gold, 60% backed by the currencies of the BRICS countries.
Mhm.
What's your opinion on that? And is that just another nail in the coffin of the dollar, or is that relatively insignificant in your view?
I think it's relatively insignificant. They're smart to include gold because their currencies don't have much credibility, um, and that gives them some credibility. But I think we're a long way off from the dollar losing its status as the global reserve currency. I think that's so far off in the future, if it happens, that it doesn't really it's not really relevant to us today. That said, the trend is to sell America globally. The trend is to try to diversify away from the dollar globally. And I think that's going to progress slowly and sometimes more quickly. And part and parcel of that is the trend toward buying gold and at any level. And central banks are not that price sensitive. So, despite the gains that we've had, yes, from a dollar cost averaging basis, whatever they've allocated to buy gold is going to buy less gold, but they're still buying at these levels and still building their gold reserves. And in fact, that rising price of gold makes it even more evident to them that they need to own it.
So, Brian, you mentioned just a moment ago different ways to leverage metals in your portfolio. I'd love to explore that with you. And by the way, if you're just tuning in, I'm chatting today with Mr. Brien Lundin. He is the publisher and editor of Gold Newsletter. You can learn more at goldnewsletter.com. I'd encourage you to do that. I personally am a subscriber. I'd encourage you to do the same. So, talk a little bit about different ways to leverage metals in your portfolio, short of owning the physical metal. And I'm sure you'd probably advise people you want to own some physical metals first before you start to leverage. Let's maybe start there and then get into different ways to leverage this.
Yeah, that's vitally important. I tell people, and by the way, we have a free report at goldnewsletter.com that explains every way everything from soup to nuts on how to invest in precious metals, et cetera. But I tell people there's two reasons to own gold and silver. One is as insurance, and you need physical metals or access to physical metals um, to do that, to accomplish that. And that should be your first step. The other thing is as investment. And if you're going to invest in the sector, the classic way to get leverage on the metals is through mining stocks. And this is, it's a unique market environment that we've been in that we've never seen before, because this gold market primarily has been driven by central bank buying. And central banks don't buy the typical levers to gold. They don't buy silver, and they don't buy mining stocks. Silver, of course, has made up lost ground and really caught up to gold and performed recently its classic role as a leverage to gold, is outperforming gold. Mining stocks, by and large, haven't. And we're going to see as these earnings reports come in, and as mining companies are selling gold at $4,500, $5,000, and the like, their profit margins on a dollar basis are far larger than the gold price itself was last year at some point. So they are just making money like never before. So their share prices, granted, have risen, but their P to E's, their earnings, their price to earnings are still at typically very low levels, historically low levels. So they have yet to really trade appropriately to the gold price. So there's a lot of opportunity like I've never seen before, frankly, in the big miners. And then as you go down the food chain to the intermediates, the mid-tier miners, the developers, and the exploration companies, there's a lot of opportunity all along the spectrum. And readers of Gold Newsletter right now, frankly, are making an awful lot of money in that sector.
So, Brien, let me back up a minute, because you said we might have a couple cycles left, maybe 3 cycles left before we get to a reset. What does that reset look like in your view?
Yeah, I think that each one of these cycles, each one of these crises that are, actually created by the Federal Reserve and by a bunch of credentialed economists thinking they know more than the market about what the price of money should be. So they create these crises, and then they flood the market of liquidity that blows up the next balloon, and in the next bubble that gets popped eventually. Then they have to come in and do it again. So we've seen these happen, and we've seen that characteristic that they have to do more each time to get the same effect. My underlying thesis is that as these occur more and more, even the general public is going to start to realize that the currency is going to get cheaper and cheaper, that the powers that be are going to flood the markets with more currency. We're going to see that in inflation, of course. But I think the currency loses credibility. At some point, not just the dollar, but all these currencies will lose enough credibility that they'll have to reattach to gold in some form or fashion to reestablish that credibility. And it'll be necessary. And whether that happens officially or unofficially, as is happening right now, remains to be seen. But I think we just can all clearly see the trend.
So, Brien, we have time for just one more question. Back in 1933, President Roosevelt issued an executive order that made it illegal for American citizens to own most types of gold, with just a few
Mm-hmm.
exceptions. What's your take on the probability or possibility of history repeating itself and seeing the government do something similar this time around?
Yeah, interestingly, our organization and Gold Newsletter was founded when Nixon closed the gold window, cut the dollar's convertibility into gold in 1971. And our founder, Jim Blanchard, was instrumental in getting FDR's edict overturned and making it legal for Americans to own gold again, which of course protected a lot of people during the inflation of the 1970s. I seriously doubt that the government could get away with confiscating gold again and making it illegal again. I think it's become so well established as a fundamental underpinning of people's investment portfolios I don't think that any politician could survive the political whiplash of doing that. So it's a long shot to me. I don't think it's likely. I think it's very unlikely. But heck, they did it before, so they could do it again.
Well, the clock says we're going to have to leave it there. I can't believe how fast 18 minutes went by. My guest today has been Mr. Brien Lundin. He is the publisher and editor of Gold Newsletter. You can learn more at goldnewsletter.com. Brien, always a pleasure to catch up with you. Thank you for joining us today.
Always a pleasure to talk to you, Dennis, and look forward to the next opportunity.
As will I. We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Thanks again to Mr. Brien Lundin for joining me on today's program. It's obvious now, Jerome Powell is on his way out. He's done in May as the chair of the Federal Reserve, and many analysts are now of the opinion that the nominee to replace Powell, Kevin Warsh, will be hawkish on inflation. In fact, many analysts are saying that's one of the reasons that we saw the pullback in gold and silver. However, when you say that Warsh will be tough on inflation, he'll be hawkish on inflation, I'm not so sure. I think the Fed is painted into a corner, and I think what you're hearing there is largely what they think people want to hear. Let me tell you why I think this. The most recent appointee to the Federal Reserve Board of Governors, Stephen Moran, he was Trump's nominee, he was appointed, in a testimony that he gave before the Senate Banking Committee said this, and I'm quoting, "Congress wisely tasked the Fed with pursuing price stability, maximum employment, and to moderate long-term interest rates," end quote. Now, if you have been an observer of the Fed, even a casual observer of the Fed, you know that historically speaking, the Fed has had two mandates, price stability and maximum employment. And yet here we have Mr. Moran saying there is a third mandate to moderate long-term interest rates. That testimony was, at least to me, a bit surprising given that the Fed previously has had only the two mandates that I just mentioned. By adding the third mandate, by discussing this third mandate, Moran, in my view, tipped his hand. While the Federal Reserve does control short-term interest rates, specifically the overnight lending rate, the market controls long-term interest rates. This is why, and you can go to retirementlifestyleadvocates.com, create a free login, and read any of my Portfolio Watch newsletters over the past 3 or 4 weeks, and you'll see more documentation of this fact. But as the Fed has been cutting interest rates since September of 2024, long-term interest rates on U.S. Treasury debt and on mortgages have been going up. You have to ask why. The answer is very simple. Lenders will demand an interest rate that is commensurate with the risk they perceive they are taking in making the loan. Since the Fed began cutting interest rates in September of 2024, long-term interest rates on U.S. Treasuries have increased for one reason. The U.S. government is not as good a credit risk as it once was. Now, if the Fed is now going to control longer-term interest rates, or if they're going to moderate long-term interest rates, here's what you need to remember. There's only one way to accomplish this. You create currency to create demand for longer-term U.S. Treasuries. This is called yield curve control. Japan did it from 2016 to 2024 and had to stop because of the inflation it created, because of the supply shortages it created. This may work for a short time here in the U.S., as it seemed to in Japan, but over the long term, it will fuel inflation. So as time passes, it now seems clearer that this will be the Fed policy moving ahead. That being the case, owning assets in your portfolio that can't be printed will be critically important. That's my program for this week. Hope you got something you can use. I'll be back again next week. Thanks for tuning in.